this is Jordan with the Rose City Lending Group, CMG Financial. I'm very excited to have Dave, the head honcho and kind of the pioneer behind our all-in-one product. He came down back in August to help us roll out the product in Texas, and really excited to share with you guys a little bit about the product, who it's designed for, who it's good for, just a little bit about what it can do for someone financially. Really excited to share this with you guys. Hey, Dave.
Hey, Jordan. Thanks for having me. I appreciate it. And I don't know that visiting Tyler, Texas in August was the best decision I ever made, but I actually, because of the heat, it was great. Actually, it wasn't that hot. It was a lovely town. My first time out there. And I can't tell you that I look forward to coming back again. And as I just learned, it's extremely cold out there, right?
Yeah.
It's kind of the opposite, but I think I told you when I was out there to invite me back during Christmas, because you said the whole town lights up.
Yes, it does. Downtown is beautiful. All the neighborhoods, everyone does a really great job of putting all their Christmas lights up. It's gorgeous. I mean, it could be 70 degrees and it could be 11. So, I mean, weather, dependent, but just pack for all seasons when you come.
Yeah. Well, I can't wait to come on down there and continue to, evangelize about the all-in-one loan program. It's certainly special. And as you mentioned, it's sort of new, right, to the state of Texas, and for a lot of different reasons.
Right.
But certainly excited to be here with you and to help you share the news.
That's awesome. So we've about 25% of our pipeline last month was all-in-one business, which is huge. People that have had 2.5% interest rates are getting out of those and getting into an all-in-one product. Like, people aren't so wrapped, hanging on tight to their 2.5%, 1.99% interest rates anymore, because of what this product can do for them. And I really just kind of want you to touch on how it works and why the interest rate's kind of irrelevant, which is a hard thing for people to grasp. But I mean, I'll be honest, Dave, like, I was really skeptical about this product. I was here for about a year before I would even really dive deep into the product, because I was skeptical of it. And once you came down, right? Once you came down to Texas and you got me in front of you, it clicked for me, and it clicked for my people and my borrowers and my realtors. And now I can't stop talking about it.
That's great. I mean, I think one of the reasons for that is I think just in general, as human beings, we are sort of skeptical people. I think especially as it relates to new ideas that come out of the mortgage industry, I can understand why there's skepticism and apprehension as it relates to anything new. But I think also one of the other things that kind of causes that innately is the fact that we really haven't been promoting the product in Texas, strongly for quite a while. And like we were sort of speaking off camera here, that's partly because we didn't have it available for primary residences, otherwise known as homestead, properties in the state of Texas, which I think, causes, sort of apprehension by default. If you don't have it available for primary residences, but you do on second homes and investment properties, there must be something wrong, and also just it takes, I think, a bit longer to educate people and for people to understand how actually practically brilliant it is and very simple it actually really is. And of course, we're speaking about the product called the all-in-one loan. When you mention everybody's focus on interest rate, you're absolutely right. I think we're kind of programmed from our youth, right? From the very time that you get your very first credit card or checking account and begin to shop for a car and really begin to kind of engage life and take on some greater responsibility, certainly loans, borrowing money. I think we're just kind of taught from an early age to make sure you're getting the best deal. And the best deal has always been centered almost exclusively on the topic of interest rate. I mean, do you recall having a conversation with your parents as an example?
Yeah.
To say,
this is the product what our parents had and what their parents had and what
totally.
Had.
But nobody sat you down and said, hold on a minute, your rate actually matters less than you think. The term that you're signing up for, the length of time you're agreeing to remain in debt and pay back that money that you're borrowing, as well as the control, the actual control, monthly control of your principal balance and how your payment money is being used. Nobody really sits you down and talks to you about those things, right? And creating awareness and making sure that you're actually selecting loan products that are more efficient than others. And frankly, it's really none of our faults. The lending landscape really hasn't innovated in ways that change that. We've been using the same types of products to borrow for, really, especially for housing since the Great Depression era. The 30-year fixed is the gold standard. So we kind of grow up in as we begin to kind of, I think, take that responsibility on as becoming a homeowner and borrowing for a mortgage. We just kind of gravitate towards the stuff that we're more familiar with, right? And that our neighbor has and that our parents have and et cetera, et cetera. Rate tends to be the focus on measuring whether or not you're getting a good deal or not. Well, the reality is that the thing that's actually more important is interest dollars, not just interest rate. Interest rate is really only one part of the equation that equals interest dollars. When we ask people what's more important to them, the interest rate that comes with their mortgage or the amount of interest they have to pay on their mortgage, without question, 100% of the time, people say, well, of course, the money I have to spend on the mortgage is more important than my rate. So how can we create a mortgage product that actually minimizes the amount of interest you have to pay, whether the rate is high or low, right? We're obviously today, as we sit here in December 2022, in a higher rated environment than we were last year at this time, arguably, right? Or even the year before that. Rates ebb and flow. They move up and they move down cyclically. It's just that's their cycles, and they'll always do that. None of us controls those things. The idea behind the all-in-one loan mortgage product is to help people shrink the size and the cost of the mortgage faster, safely, without disrupting their lifestyle, without a change in their budget or their financial health, and also without having to rely on interest rates moving favorably lower. If you can achieve savings, time savings, money savings, then that also creates opportunity for people, right? Not only to live more securely with less debt, but also there's optionality that comes with that, meaning people have more choices. If you have more money available to you, then you can do more things. One of those things we believe people should do more of is probably save, probably prepare for a rainy day, for their retirement, for all the other things that we tend to not be able to achieve very easily. So, focusing on the mortgage and innovating the mortgage in a manner that helps people with those things was our goal. That's what, to your point, why people gravitate towards it, why they're so interested in learning about it, even if they've got a 2.5% interest rate. The reality is that that's not the end game. Zero is the end game. The reason why you get into a 2.5% 30-year fix is not so you can pay 2.5% for the rest of your life all the way until the day you die. You actually want to get to zero. Everybody does. Zero cost, zero interest on a loan. Wouldn't that be great? Yeah. The real question is whether you want to get there sooner or you want to delay that process. And the all-in-one loan is engineered to help people get there sooner, much sooner. So that's the point of the product, and that's why I think you're having such success with it, even though you kind of new to it yourself in a way.
Yeah, it's expediting it's more than a mortgage. It's right. It's totally more than a mortgage. I had a client recently who cashed out, tapped into the equity, paid off everything. They had 2 vehicles, 3 credit cards they could never get out of, tapped in their right. equity, and they had a 29 years left on their mortgage, paid off everything, utilized this all in one, and they'll be 100% debt free, their house included, in 7 years.
Yeah, it's meaningful, right? It's what I call a meaningful transformation. Sure. And that when you achieve that, especially as a service provider, right, in which we are. So in terms of the product structure, if you don't mind, let me touch on that very, very briefly, just so that your audience can understand how it works and what it is. We can even talk about the differences between what's available for primary residences versus maybe a vacation property or an investment property. And there's some opportunities there too with those real estate investors out there that I think we should touch on. But the structure of the loan is that it combines a mortgage with personal banking into one fluid account. If you really think about it, it makes a lot of sense, as you already know, Jordan, where most people will earn more money in a pretty short amount of time in their life, even just 5 years, most Americans will actually earn more money in 5 years than they actually owe on a mortgage. And when you kind of think about it, you go, gosh, where does that money go? Where's that money get placed? Where's it managed from to pay my bills and expenses, including a mortgage? Well, it lands in this thing we call a traditional checking account. So the idea behind the loan is to link these together, put them into one consolidated account that allows this interactivity, I guess, this engagement, automatic engagement to help shrink the mortgage principal faster while keeping that money available on a daily basis, 24/7 for bills and expenses. Now, paying down the mortgage balance faster means that the amount of interest that a customer is charged monthly, annually, and over time is going to be reduced, significantly reduced. So that's where the savings is generated, using money into the mortgage to help reduce the principal. If even for a day, you're saving money because of the way interest is computed on the loan. Therefore, your monthly interest payments, annual interest cost, total interest costs are significantly reduced. And the other thing that this does is while you're reducing what you owe, you're building equity. I think that, you correct me if I'm wrong, but I think most consumers out there tend to think of the development of equity in their home is only really achievable if prices around them go up, right? So market values of real estate around their home also increases. Home appreciation is how you achieve, greater equity in your home. There's also another way. That other way is through the reduction of what you owe on your loan. By reducing principal, you have a greater equity stake in your home relative to its value. So that value is going to fluctuate. Wouldn't you rather take control? And that's what this does. It gives people greater control, much greater influence over their costs. And that money remains liquid and available for them 24/7 over the term of the loan, for spending needs and other financial goals that they come into.
Yeah, absolutely. So tell me a little bit, about how the product actually works and why it works.
Right.
You get your paychecks. Your paychecks are deposited into the account. You on a Texas primary, you deposit those onto your mortgage pot, is what I call it. Mm-hmm. And you can use that money and take out as you need to pay bills.
Right.
When I talk about this product with clients, originally they're like, "Well, I need money out of my paychecks." Like, right, it's available to you, but it makes more sense. I mean, usually all your bills don't come out on the first. They might be sporadic through the month, which is neat because we allow the statement or the payment not to be due until the 21st, which allows you 20 days to keep your balance reduced before you make that mortgage payment. Right. Kind of explain how that works.
Yeah. So the way I really, kind of chalk it up is there's really two types of all-in-one loans. There's what I call the standard structured all-in-one loan product, which in the state of Texas would apply to an investment property and second home. And for homestead properties, primary residences in the state of Texas, to comply with some of the constitutional rules, the structure of the all-in-one loan had to be changed slightly. So in the standard all-in-one loan, again, available for investment properties and second homes, whether it's a home purchase or a refinance into it, the way it works is when a customer deposits any amount of money into the linked checking account, that checking account also serves as a zero balance sweep checking account. I know that's a mouthful, but what that means is it has this added engineering to it where it automatically transfers the money from the checking account the day that deposit is made. It could be $1, it could be $10,000. Doesn't matter. Doesn't matter the amount of money, the day that it's done, or the frequency that a deposit is made. That money hits the checking account, and instead of letting that money sit there, stale, sort of idle, earning nothing in return, the all-in-one loan checking account transfers directly to the mortgage and applies 100% of those dollars to the mortgage principal, paying it down that day. We're going to recompute interest that day at the end of the day as well on that lower balance. So people can basically use the all-in-one loan to borrow and bank from. It's a more efficient way to manage their cash flow. Money's constantly available for them to bill pay. Comes with ATM, debit, Visa cards, check writing, online banking, mobile banking. You can link external accounts to it, move money back and forth, just like any other standard checking account. You engage your mortgage through this checking account, placing money into it, taking money out of it as you need. And the daily recomputation of interest is what helps people save money at the end of the month. On the homestead version, it's slightly different, where it doesn't automatically transfer the money, the deposit, over to the mortgage. It keeps it in, the deposit remains in the checking account. And the customer then decides what they need on hand for bill payment and expense needs, maybe over the next couple of days, and what they don't need for a while. What they don't need, they can schedule in advance or actually do it that day, a transfer of those funds directly to the mortgage to pay down the balance and pick up the benefit of the daily interest calculation on that lower balance until they need some of those funds back out again. So that's one slight difference. Any money being moved out of the mortgage for a primary residence all-in-one loan has to be taken out in minimum advance amounts of $4,000. So that's a Texas constitutional guideline. Advances from this mortgage have to be a minimum of $4,000. So this is why we basically cut off the automatic sweep or transfer from the checking account to the mortgage. It's because we wanted to give people the choice. You decide if you need to maybe go grocery shopping tonight. So you got to keep some money in a checking account. That's fine. That's exactly what you need to do, and keep those dollars on hand in the checking account and not in your mortgage. To comply with the rules down there, that's how we structured the loan. But it provides the same benefit, which is daily interest savings on money that you don't need to have on hand or use today. It's the whole point of the product. That just accelerates pay down and pay off and equity growth, in the home. So those are the biggest differences. Same benefits. What we find too, Jordan, is that as I describe the differences in between the standard, which is an automatic transfer of 100% of the funds, versus the homestead version for Texas, which doesn't do that and gives the customer complete control of it. What I find is a lot of people are like, gosh, I think I like the Texas homestead version a little bit better. People love the idea and the control factor, but they go, gosh, this elevates the control factor even more. Gives me the complete control of what's in the checking account versus what's in the mortgage. But the entire idea behind the loan is money that you earn tends to earn little interest, a lot less interest than we have to pay on our debts. Your biggest debt in life tends to be your mortgage. So let's get that money, which is a powerful resource, into the mortgage as fast as possible to reduce what's owed, therefore reduce the amount of interest you have to pay on that borrowed money. The other aspect about the loan that I want to make sure is clear is that the mortgage side of the all-in-one loan is actually a first lien position home equity line of credit. For the standard all-in-one loan for for second homes and investment properties, it's a 30-year draw. So I don't think there's another home equity line of credit or mortgage product like this where it provides you access in and out for full 30 years. For the homestead version, it's a 25-year draw home equity line of credit. So slightly less draw timing on it, but you can freely put money into it to pay down as fast as you want. Money's kept liquid. You can pull it right back out freely for 25 years.
Man, every time we talk about this product, I get more and more excited about it. I love it. I love what it's going to do for my borrowers, and I love what it's going to do for my real estate investors. So one of my favorite parts about the product is the escrow piece. You don't have to pay the escrows, your taxes and insurance. You get to save.
That's right. That's right.
Save that and hang on to it. Use that money to lower your balance until they're due annually.
It's a powerful sum of money over time, right? And instead of giving it away to the lender or the bank ahead of your tax premiums or insurance premiums, so that they can benefit from your money in an account that they're earning interest on, how about you keep your money right until those bills are actually due, and that may not be for months, right? So here's the thing that a lot of people don't realize. They likely have already earned the money needed to pay bills and expenses for maybe next month. That money's already probably on hand in their accounts today. What's it doing for them besides remaining available for them? Nothing, right? I think the national average yield for checking accounts is somewhere around the 0.03% range still. So, obviously we don't look at checking accounts as being an investment account. It's really not giving you anything. So the idea again is to, while you have those dollars on hand, put it somewhere that is costing you an arm and a leg so that you can reduce your exposure to that cost. I mean, it's real simple, right? It's a more efficient use of the dollars through its structure.
One of my other favorite parts about the loan is that you can use it for, I mean, it's your equity, it's your dollars, you can use the funds from your mortgage for whatever.
That's right.
You pay off your mortgage and let's just say 5 to 7 years, and you've always wanted to tap into getting into real estate or buying investment properties. You can use those funds to buy up more real estate and invest. And I mean, you can, the options are endless, and that's really neat. Very neat.
It is. It's a phenomenal product especially for the real estate investor out there. I know there's a BRRRR community as well, as we reference them. Buy, renovate, refinance, repeat, where building that portfolio really makes a lot of sense. I can't think of a better, more viable, exciting asset to commit yourself to than American housing, without question. And most people in America need to borrow money in order to own real estate. So it's sort of a necessary evil. This is just a point of innovation that makes it easier. Again, simply put, I think that if people had more money available, they would be more active in real estate and securing their financial future, and maybe, sending their kids to the college of choice without having to go, decades into debt again. I think as a real estate investor, there's two things that people really want that this solves, where a traditional mortgage sort of, creates limitations. One of those things is that real estate investors want to grow their positive cash flow position in their homes that they own, right? So that's the difference between their mortgage cost versus what they're receiving in income off that property. So traditionally, the only way you can really achieve the greater cash flow is by either increasing rents or leases, whether that be long-term or short-term rental income, or maybe refinancing your mortgage, your traditional loan, to lower your payment. Well, nobody really controls interest rates, right? None of us control, let alone influence. So that's not always feasible. Sometimes it doesn't make sense to increase what you're asking, right, to rent your place, because you don't want it sitting out there on the market. You want it filled and producing income. So it doesn't always make sense to increase what you're asking for either. So that's the all-in-one loan solves that. I would say a third thing that is pretty prohibitive with a traditional loan is liquidity, right? I think real estate investors want and need liquidity to continue to do what they're doing, but also to maybe repair their property, renovate, improve it, buy again, buy another one. People need to chase interest rates and tend to get another loan or have to get another loan to achieve those things. It's all built into one in the all-in-one loan, right? You're reducing your monthly mortgage expense because ongoingly your interest costs are reducing, right? Zero, it drives it to zero faster. Your payment obligation reduces automatically monthly just by using it. So you grow your positive cash flow position automatically. Number two, liquidity. All that money, all that capital you're using to pay down your balance with, that savings that we're farming, is available for deployment. That could be used to renovate or repair or go for another down payment on another property or buy another property in cash. So it accelerates these goals, right? It doesn't impede them. It accelerates them. That's, of course, I think what most of us want.
Yeah, for sure.
Yeah.
So something that you mentioned that continually stands out to me that you mentioned back in August. So, as borrowers are like, oh no, I've got a 1.99 or I have a 2.5 or a 3% interest rate. I'm like, well, how much longer do you have left on it? Well, I refinanced last year. It's 29 years. I mean, would you rather pay, 2.5% interest rate for 29 years, or would you rather pay 7 for 6? Because that's, the end of the day, your goal is zero balance. Your goal is not to have a lowest interest rate. That's a pride thing. Like, I think people, tend to take pride in their interest rate. And I get it too. Like, yeah, it's cool. Like, we all, for us that bought in 2020 and 2021, like, we have a significantly low interest rate, but at the end of the day, like, my low interest rate, I'm going to be paying on that for 29 more years.
Totally. Totally. I'll give you some quick math and an extreme example of how, we tend not to focus on the other two components, the other two variables. Somebody said once that we've worked with, a very well-known economist, said once, he said, a loan is just a mathematical equation. There's really only three parts to that equation: interest rate, your balance, right? What the interest is being computed on. So your principal balance matters. And of course, how long you're going to carry a balance. So the time, principal outstanding, and rate. So rate, again, tends to be the driver, the primary influencer of decision-making. But people utterly almost avoid or kind of ignore the other two parts of it, right? The other terms of a loan. That's what the all-in-one loan tackles. It focuses directly on reducing principal faster with money that people already have, which is a greater sum than the amount owed on a mortgage, by the way, in order to reduce the amount of time that any money is owed, which offsets the amount of interest dollars people have to pay, right? And you're exactly right. If you do some quick math, if you borrow for 30 years, commit to a 30-year repayment plan at 3%, regardless of the amount that you needed to finance, it's all the same, whether it's $100,000 or $1 million, it's the same. What you're actually committing to pay is about $52, $53, right in that range, in interest for every $100 you're borrowing in principal, right? So you're adding essentially 53% cost to your life because of that, the way that mortgage is structured. It may come with a really low rate, especially relative to where they're at right now, and that makes you feel good and secure. But the reality is that it's still highly expensive. And when you look at at what point in time am I paying that interest? Is it just a little bit over 30 years? Every month, am I paying just a little bit of that interest, or is a lot of that interest? The downside is that on a traditional mortgage, in that payment plan, it's front loaded with that interest cost. Typically, people will pay about 50% of the total interest in just the 10 years alone. And Jordan, you and I both know that most Americans don't get a single mortgage and pay it off. They tend to recycle that debt pretty routinely, again, as they chase interest rates around. And also sometimes they need equity money. They need access to equity money, right? For other goals. Well, what if it was all consolidated into one account and your money was offsetting the total interest dollars you have to pay, whether rates were higher or lower, or higher or lower as they move cyclically? You almost don't even worry about interest rates when you have this mortgage. You really are looking at your principal balance, and it's gratifying for people to realize how fast it falls and how much equity they build and how much money they're saving through that process so rapidly.
Dave, thank you again for coming out in August. Thank you for meeting with me today. You and Aaron both have been such a resource to us, to my team, to be able to share this product and how neat it is and what it can do for our clients. And so I really appreciate you and all the hard work that you and Aaron put into supporting us.
Thank you for saying that. Yeah. Shout out to Erin Wood, my colleague. Yeah. She works hard to help me, share the news, and she's great. So I really appreciate that. She'll appreciate it too.
She's awesome.
We work hard. Yeah. Well, thanks for having me, Jordan. I appreciate it. I can't wait to come back out there.
Yeah, you got to come soon. You got to come really soon. Or trying to happen. We're working on doing another big event just for those that couldn't come back in August, and or those that kind of just didn't weren't ready to listen.
Came for the food that day.
Maybe came for the food that day. Yeah. And I think it takes a couple of times to get your mindset right about getting your mind wrapped around this product, because it is a little bit more complex, but it's not necessarily complex. It's just different than what we've been taught, or what.
100%. It almost requires you to. It forces a change in the way we think about money and mortgages. We've been taught for so long, and so this. We try to. You have to kind of unwind some of that knowledge, right? That was kind of founded in familiarity, and not necessarily challenged by a lender, by innovation. This challenges that. I would argue, as your listeners and audiences watching this, and and maybe will participate in another meeting, another event, or conversation with you and your team members. Consider a mobile phone for a second. Your cell phone is not just a phone; it's a computer. And it bundles together a bunch of products and services that you now have access to at just the touch of your finger, and you can communicate and manage your life in just a microsecond, right? And that's wildly different than the way we managed our lives, whether it be mobile communication or just use of computers and typewriters and how we exchanged information just 20 years ago. I mean, so that innovation has really created efficiency. Sometimes it takes learning about something new in a better way in order for people to recognize kind of the stale, archaic way that we've been doing things for so long, right? Just because we've been doing something for so long doesn't necessarily mean that it's the best way ever that it's going to be. Innovation is necessary. It advances our cause, and housing is one of the most important things people can commit to. We ought to be advancing, the mortgage itself to make that easier. So that's the whole point. I appreciate the opportunity and can't wait to come back out. So thanks for having me, Jordan. I appreciate it.
Thank you for being here, Dave. I appreciate it. You guys, if you guys are interested in learning more about this product, please call me 903-316-2883.